All right, listen up. Market opens in 30. We enter on the dip, ride the momentum, and exit before the bell. Alpha monitors order flow. Bravo manages hedges. Charlie watches our exit triggers.
In this lesson, we're going to explore a set of tools that help us measure volatility, structure, and efficiency in price action. The average true range, the median of price, trend lines, and fair value gaps. These concepts work together to give you a clear view of where the market is moving, how strong that movement is, and where it might rebalance before continuing. Let's start with the average true range, or ATR. ATR is a volatility indicator. It tells you how much an asset typically moves within a certain period. It doesn't predict direction, it measures movement magnitude. For example, if the 14-period ATR on NQ reads 25, that means NQ has been moving an average of 25 points per candle over the last 14 periods. This is powerful information because it helps you size your stops and targets logically instead of emotionally. If NQ's ATR is 25 points and you set a 10-point stop, you're risking less than half of the normal volatility. That trade might get stopped out just from normal noise. Instead, use ATR as a volatility gauge. For example, conservative stop equals 0.5 times ATR. Normal stop equals 1 times ATR. Wide stop equals 1.5 times ATR. The ATR adjusts with market conditions. When volatility expands, your stops and targets should expand with it. Next, let's talk about the median of price, sometimes called the equilibrium point. The median is the midpoint between a defined high and low. It's where price finds balance. If NQ ranges between 15,400 and 15,500, the median is 15,450. Price often reacts around that midpoint, rejecting it when imbalanced or consolidating when balanced. Understanding the median helps you read whether the market is premium above fair value or discount below fair value. Institutional traders often build entries around these balance points, buying below equilibrium and selling above it. The median also ties directly into our next tool, trend lines. Trend lines visualize direction and rhythm. A proper trend line connects at least 2 or 3 swing points, higher lows in an uptrend or lower highs in a downtrend. The key is consistency. Draw trend lines that connect wicks, not arbitrary points. In an uptrend, price will often respect an ascending trend line, pulling back into it before continuing higher. In a downtrend, descending lines act as dynamic resistance. Trend lines show structure, but they also reveal momentum. When a trend line breaks with strong volume, that's an early signal of a potential shift in market direction. Combine trend lines with the median of price, and you'll start to see where price wants to return for balance. That brings us to fair value gaps, or FVGs, a concept made popular by institutional trading models. A fair value gap is an imbalance on the chart, a zone where price moved so aggressively that it left unfilled orders behind. You can spot an FVG on a 3-candle sequence. Candle 1 pushes in one direction, candle 2 continues strongly, and candle 3 leaves a gap between candle 1's wick and candle 3's wick. That open space between those two wicks is the fair value gap. Price often returns to these zones later to rebalance the inefficiency before continuing its trend. Think of it like a footprint left behind by aggressive institutions. They moved price so fast that liquidity didn't have time to fill in. FVGs can serve as both targets and entry zones. In an uptrend, look for price to dip back into a bullish fair value gap before continuing higher. In a downtrend, look for price to retrace up into a bearish fair value gap before selling off again. The key is context. When a fair value gap aligns with structure, a demand or supply zone, and the higher time frame trend, it becomes a high probability setup area. Now, let's tie these tools together. Use ATR to measure volatility and set your stops. Use the median of price to understand equilibrium. Use trend lines to define direction and momentum. And use fair value gaps to locate inefficiencies where price is likely to react. Together, they give you a complete tactical map of the market: volatility, balance, structure, and liquidity. As always, simplicity wins. Don't overload your chart. Use each tool with purpose and confirmation. The more you understand these mechanics, the more you'll see how price moves like a living system, expanding, contracting, balancing, and rebalancing in an endless rhythm. In the next session, we'll go hands-on with chart examples, applying these concepts to real YM and NQ price action. so you can see exactly how to use them in the live trading conditions